Hi, good afternoon, Futex traders, and welcome to an afternoon FX and commodities stream. Doing a special stream today, going to be looking at the gold markets. It's actually looking at the markets this weekend a lot with Brannigan Barrett speaking about many things that potentially look alluring for 2016. But gold for me is a very special place to be looking at in 2016. Some very interesting setups, some very interesting period analysis, which is one of my favorite forms of analysis, which I'll explain in a little bit. But gold really something that from an investment perspective, an investment climate perspective, is something to really keep a close eye on in 2016. And remember, very important, whether you're an intraday trader or a long-term trader or an investor, that the trade only is valid and working out when it is working out. If the trade is not meeting certain criteria, not breaching new boundary, not laying out like you expect it to lay out according to an execution plan and a trade management, well then don't get caught up in some analysis which is not really working because the prices are not telling you. But always good to have a setup and key setups that you look at either on a day or key charts. And whatever I do every single year at the end of the year, I always try and lay out some key themes, key macro themes that I'm looking at for the next year. And one of those key macro themes for me, which will also help with a sector rotation in the equity markets, is gold and oil for 2016. So let's now have a look at what we potentially have in play for next year. Now we'll be looking at a few things with regards to gold. We're looking just at the structures, but first I'm going to do a period analysis. Now what a period analysis is for me is I look at particular specific periods in time that I like to analyze the market, where we have some general same themes or same economic climate or technical climate that we had in the past, and we look at today. And got a few friends who work at a hedge funds. They work in the commodity space, and what they do is they effectively do regressive models, and they model their data based on correlations with the a 30-year period mapped to a recent 5-year period mapped to the most recent 1-year period. And when all of them show high correlation, then they start executing certain plays on that. For the younger traders, Futex, if any of you guys are interested about that type of analysis, then just get hold of me in the office when I'm either in London or working. So let's look now. Now what I've done here on this top frame here is just the recent climate. Purple line is the oil market and the oil price, and this golden line is gold. And this is where we're now in the current economic climate. Then the bottom chart is, again, we have the purple line being oil, and then the yellow golden line being gold. And this is the period really for me where I've been looking at oil very closely. This is the 1986-87 period, which is an analog to where we currently, the oil move. The last time we had such a precipitous decline in oil, barring the financial crisis, was really back in 1986. So 2014 to 2015, we had a move down in oil of around 38% from this peak over here towards this low over here. So that really is move of around 38%. It went from just over $100 a barrel to around $45 a barrel. And over here, well, we had a move from around $32 to around $11, and that was a move of 35%. So very similar, 38% move there, 35% move. Now, if you see here, we've got this open terrain. You can see how closely gold and oil were effectively mapping each other. They were fairly highly correlated during this area, or at least just moving sideways. And then we had a strong move down in oil, and this was, if everyone remember, the move down from around 1800 to around 1150. Now, from the height of that move from around 1800 to where we are now to around 1040, that move has been around 42% down move in around 165 weeks. So 42% down move. Now, before we had that oil move, you can see over here, we actually had, so gold went down first, and gold sold off first, whilst oil still held its range, and then it took about 2 years about a year and a half before oil then started selling off. And now you can see gold and oil has kind of been moving sideways the last few months in a broader type range. And you can see now over here, now unfortunately I don't have data of oil that precedes 1983, but what I'm trying to show is that the last time we had this type of relationship, and I really like 1986, 1987 as an analog with oil prices. Well, look, we had gold declining around 43%. Between 1983 to 1985, so 43% move in gold. Same over here, we had a 42% move from effectively high to the low. So from this swing high to this swing low to the absolute low when we held $300 an ounce was around 43%. So very similar, and you can see the gulf until oil then declined and started moving in sync with a gold. And only once oil started trading sideways and started moving sideways, then did gold start leading the up move. So gold led the down move, and then gold led the up move. Oil lagged the down move over here. Oil lagged the down move over here, followed by a move towards the upside. Now, what's also interesting is after oil's precipitous decline, we also had the Fed funds rate being on hold or declining, and only once oil stabilized did the Fed funds start increasing. Fairly similar situation here currently in 2015 and 2016, when there is expectation for the Fed fund rate to start rising, going into 2016. So once oil stabilized over here, and looking like oil is stabilizing around the $40 a barrel, that's what I'm looking for 2016. Oil ready to start stabilizing at these levels and maybe start trading a little bit higher. Conviction levels on that play is not as high as gold moving up towards the upside. Now, once oil, this purple area here, once oil started making its bottom and started finding a bottom, well then, that's when you started getting gold moving up. So you can see the move from the low from $287 a barrel, $287 an ounce to 500, almost a double increase in gold. So that was, once the low was effectively hit in 85, then to 87, we had a move. And if I do that in percentage terms over here, so I take the low over there to that peak, well, it's an 80% move in gold. So this, again, if you look at a period analysis, gold led the down move before oil followed a little bit later. You can see this little gap over here, market highly mapped and trading in range. Then gold led the down move, oil followed later. Here we have this a similar gap over here. If I just move that so you can see, very similar over here. Gold leading the down move, oil staying horizontal, then oil following, and then once oil had based out over here, and you can see in this 85-87 period, we started, and analysis that I looked at the beginning of the year with, after we made these lows in oil this year, which was in March, we spoke about when oil was trading up here, that a new cycle low could be made in August. because we are mapping it to this period of 1986-87, and again in August we made this low. So between this lows, March low over here in oil, and then an August low, and you can see over here we had a March low over here, and then an August low. It took from March to August for these lows to visit. So very similar periods, very similar, lots of things stacking up over here. So for me now that oil has declined and caught up to the decline in gold, gold starts moving back up again, and gold starts escaping towards the upside. And as a result, once oil started stabilizing, that's when the Fed funds started increasing. So there's a confluence of things. Again, from a sector rotation perspective, what is important from an equity market, once oil started stabilizing, then you started having the Fed funds. So from an equity market, consumer goods, if you expect the market to pick up and the Fed to raise rates because they expect the economy to increase, and all of, again, this is very speculative, and we still, until they start raising rates, we don't know. But this is where people start switching into, to the consumer goods sector, and that's where you get the nice, great sector rotation start happening in the start of an interest rate cycle. But that's not what I'm looking at today. What I'm purely looking at today is the move in gold for 2016. Here we've had a move of 80%. I'm looking more or less of a move, in approximately, 40, around 40%. If we go look at the actual charting landscape, two things that I really want to bring to your attention. You can see, sorry, that's not it over there. If we look at gold over here, we have a falling wedge formation. It's a very neat, nice pattern, the falling wedge. Falling wedges have bullish implications. So we've also come just short. This is still a key. We can still make low lows at 1030. We want to see, once the Fed starts raising, if the Fed do start raising rates, then maybe that's when you start getting the last move towards a downside in gold. I know this is also going to be determined on the US dollar outlook for 2016, but I'm really keeping a close eye on this key swing high here. You can see we had this formation that was built up over a period of almost 2 years, where we had almost like this type of V-type, this V, or even more cup and handle formation, but it's a very steep cup over here, and then we moved aggressive to the upside. So this formation, the sideways formation, that then proved to be the base for this catapult move that's launched from 1030 to this excessive in excess of 2000. But really important to keep an eye now on gold very closely. We have this falling wedge formation, we've got this lower trend line, and we just false brokered last week. I think, if we look a little bit closer here, the last 2 weeks, and now we've had a very powerful candle towards the upside, and at least the target would be the 1200 level. So falling wedge formation, and if you have to do a momentum indicator, RSI, you'll get probably some momentum divergence, and that's worth looking at. So again, gold for me is looking like very alluring for 2016. This is the gold miners as an ETF, GDX. It's an ETF of the gold miners. Very interesting falling wedge formation over here. You can see we're also rising towards upside. Nice, neat trend line that captures all of these lows over here. Very neat. I would really like to, ideally, I'd like to see it broken towards the downside, then pop back up, and that will potentially, with good volume, if we have one volume flush, and this is just a scenario, if we have one move below that trend line, stays there for only a week or two, or just builds a base and then pops back in here, then the upside really opens up. Then we've got this lower downward sloping trend line, and you can see gold miners are really spiraling. The average true range will probably become has become really suppressed as the market really coils and waiting for an explosive move. So potential strong move over here, which will be led by gold. So that is my analysis for gold for 2016. One of my key macro themes that I'm looking at for next year, and what implications will that have if oil stabilizes, and what implications will the kind of individual stocks that you'd want to potentially look at. So all the best for this coming week and trading, and all the best for the rest of December, but something to keep an eye on from a little bit of a bigger picture. I know we trade intraday, that's our approach, but I know a couple of traders also sometimes have their long-term plays on, so this is something to keep an eye on for 2016. This is Alex Hayward for Futex Live.